Good morning, guys. Welcome to our channel where we are bringing today one of the very valuable video you need to succeed in stock market. This video is a must for those who are beginners and are looking to make money in the stock market. This guide about value investing is best suited for those who are interested in making money by value investing. So, if you're first time new to the channel, subscribe and click the bell for the notification for more such useful videos. So, let's dive into today's guide, which is about value investing. Investment in stock market have attracted the people from all streams equally well. Fortunes fluctuate and there is no decisive science to this subject. This video is an attempt to develop a methodology and systematize the effort involved in the part of investing in a scientific fashion based on the experiences of the investors and the approach practiced by them. This video aims at generating a supplementary income for the investors who pursues this as a part-time activity in addition to their main professional interest. So, what we are going to cover in this video? We will see what is value investing basics, how to do value investing formula and techniques, how to make money of value investing, deep value investing examples, growth investing versus value investing, and finally we will conclude with problems with value investing. So, first and foremost, we shall see what does value investing really mean. Value investing is a strategy where investors aim to buy stocks, bonds, real estate, or other assets for less than their worth. Investors who pursue value investing learn to uncover the intrinsic value of assets and develop the patience to wait until they can be purchased at prices that are lower than this intrinsic value. In this video, we will look into detail at value investing, including its history, how to measure intrinsic value, and alternatives to value investing. Value investing is nothing more or less than buying investments on sale. The origins of value investing go back to research by Benjamin Graham and David Dodd in 1920s when both men began teaching at Columbia Business School. Many of the concepts of value investing are described in their book. Value investing starts from the premise that an investor who buys stocks in a company owns part of the business. While this may seem obvious, many investors play the market without regarding the underlying fundamentals of the companies they own. As a business owner, the investor should evaluate the financial statements of the companies to assess their intrinsic values. This type of evaluation is known as fundamental analysis. Intrinsic value is rarely a single number. Rather, due to many assumptions that go into valuing a complex enterprise, intrinsic value is often a range. This lack of precision shouldn't concern an investor. So, now let's go deep into value investing basics. Value investing is an investment strategy that focuses on stocks that are underappreciated by investors and the market at large. The stocks that value investors seek typically look cheap compared to the underlying revenue and earnings from the business. Investors who use a value investing strategy hope that the stock price will rise as more people come to appreciate the true intrinsic value of the company's fundamentals business. The greater the difference between intrinsic value and the current stock price, the greater the margin of safety for value investors looking for investment opportunities. Because not every value stock will turn its business around successfully, that margin of safety is important for value investors to minimize their losses when they are wrong about a company. So, what makes a great value stock? So, how to find value stocks? Investing requires a lot of research. You will have to do your homework by going through many out of favor stocks to measure a company's intrinsic value and compare that to its current stock price. You will often have to look at dozens of companies before you find a single one that's a true value stock. So, avoiding value traps. A value trap is a stock that looks cheap but actually isn't. A couple of situations often produce value traps that value investors should watch out for. So, the points to remember is stocks in cyclical industries such as manufacturing and construction often see their earnings rise substantially during boom times, only to watch much of them disappear when industry conditions cool off. When investors see a possible burst coming for a stock, its valuation will look very inexpensive compared to recent earnings, but much less so once earnings during the weaker part of the business cycle. Stocks in areas that emphasize intellectual property are prone to become value traps. For instance, if a drug company has a high selling treatment but is losing patent protection for it in the near future, much of its profits can disappear quickly. The same is true for a tech company that's the first mover in new industry but lacks the ability to protect itself against competition. So, to avoid value traps, remember that the future of a company is more important than its past when valuing a stock. So, if you focus on a company's prospects for sales and earnings growth in the months and years to come, you will be more likely to find true value stocks. So, is value investing right for you? If your primary investing goal is to keep your risk of permanent losses to an absolute minimum while increasing your odds of generating positive returns, you are probably a value investor at heart. By contrast, those who prefer to follow the hottest companies in the market often find value investing downright boring since growth opportunities for value companies tend to be unenthusiastic at the best. Value investors have to be resilient as well. The value finding process eliminates far more stocks than it uncovers, and it can be a highly frustrating way to invest during a bull market. So, how did value investing get started? Value investing has evolved over time. Its roots are in Great Depression and in aftermath when the strategy focus was purely on buying companies whose assets were worth more than the stock traded for. That was largely because many companies we are going out of business during that time. So opportunities to buy stocks for less than the value of assets has direct implications when a company had liquidated. Since then, though value investing has grown into fundamental analysis of companies' cash flows and earnings, value investors also look at companies' competitive advantage to assess whether a stock is deeply discounted. So let value investing help you out. The most important thing to understand is that value investing requires a long-term mindset. As economist John Maynard Keynes said, the market can remain irrational longer than you can remain solvent. The lesson is that when occasionally one's timing is lucky and investment pays off very quickly, even a value focused strategy doesn't guarantee quick gains. Value start investing strategies take time to follow, but the time and the effort you spend are worth it. Understanding and applying the value investing concepts Graham wrote about 90 years ago and the investors have added and improved upon since will make you a better investor with better chances of being successful in choosing great stocks. So now we will move to another topic of the video, that is how to do value investing. Fortunately, value investing practitioners have put together certain rules that form the bedrock of this investment approach. In this video, we will discuss 8 key rules of value investing that you must know about. So moving to number first, that is to be calculative and not speculative when selecting the investments. An investment operation is one which, upon through analysis, promises safety of principal and an adequate return. Operations not meeting these requirements are exploratory as per Benjamin Graham. Benjamin Graham, often considered as the father of value investing, wrote the above in his classic book. There are two key lessons that you can draw from the above statement. That is, Value investing must be done intelligently, that is, it must be supported by detailed research and analysis. Second, the focus of value investing is to avoid capital losses and generate adequate returns instead of attempting to pick high risk investments with a low probability of generating returns. Based on these features, value investing is qualitative, calculative, and even predictive to some extent, but it is not definitely speculative. Coming to number second, that is to know the fundamental value of the investment. Most investors buy and sell investment on the basis of stock price movement, but value investors typically believe that the price of a stock generally matches its underlying value, that is, its intrinsic value over the long term. So, if a stock is currently priced at lower than its intrinsic value, then there is a case for buying the stock at this discounted price. Now, there are various ways in which the intrinsic value of the stock can be estimated. Some value investors use a simple price to earnings ratio which explains the price an investors need to pay for each rupee of profit. Other methods of calculating the intrinsic value of stocks include the use of relative measures like price to earning ratio of a company versus the industry. Even though there are multiple ways to determine the intrinsic value of a stock, a value investor never makes a decision based solely on the market price of a stock. Instead, determining the intrinsic value of a stock is a primary requirement for any value investor. Coming to number third, that is to ensure a high margin of safety. The difference between the current marketplace and intrinsic value of a stock is called its margin of safety. For example, if a stock is currently trading at $100 and its intrinsic value is $95, then the margin of safety for the stock is 5%. As discussed earlier, the intrinsic value of a stock is calculated using various data such as historical information about the company, competitors, industry, and other parameters. As discussed earlier, the intrinsic value of a stock is calculated using various data such as historical information about the company, competitors, industry, and other parameters. This calculation also uses some key assumptions regarding the company's future which might be incorrect and lead to errors. Therefore, having a high margin of safety gives an added cushion or safety net to the investor. Most value investors seek a margin of safety ranging from 30 to 60% when selecting the investments. This means that the margin of safety also represents the potential upside for the asset if the intrinsic value calculations are correct. So, coming to number 4, that is focus on making long-term investments. It can take sometimes for a company's share price to match its intrinsic value. This can occur due to the state of economy because the investment belongs to the out of favor sector. As it can take many years for the market value of a stock to match its intrinsic value, value investing requires practitioners to be patient and wait. By waiting, value investors give markets sufficient time to recognize the actual value of the company's stock. But being patient and waiting can be pretty difficult as we are constantly bombarded with the latest updates and trends from around the world. But patience is the key to achieve success as a value investor. The stock market is nothing short of a device that transfers money from the impatient to the impatient, as said by the investors. So, value investors should take this investment lesson from the investors and learn to be patient. So, coming to number 5, that is to understand the market driving factors. If an investor prefers to go with the flow or practices momentum investing, then the value investing might not be the best fit for you. This is primarily because stocks become undervalued when investors are looking elsewhere, and this has historically occurred many times. For example, in 2020, the energy, technology, and pharma sectors emerged as the most popular sectors to invest in. But these were the most ignored sectors multiple times between 2015 to 2019 period. So, a good value investor must have the ability to ignore the noise. This way, one can go against the momentum and the conventional wisdom to seek out investments that no one else is looking at. Taking such a contrarian stance might even look foolish at times, but to succeed as a value investor, having confidence in one's investment choice is more important. So, while not everyone have a contrarian mindset, it is an essential trait for a value investor. Coming to number 6, that is select investments that avoid loss. The legendary investors said that the United States was still recovering in the Great Depression of 1930. During this period, one out of the four workers had lost their jobs, over 4,000 banks had failed, and the stock market had lost almost 90% of the value. So, for example, if the value of an investor's portfolio decreased by 30% and then posted gains of 30%, the investor had actually not reached the break even point. The value of investments is now 9% lower than the amount that was initially invested. So, to recover the lost capital, the investor now has to generate higher returns. But seeking higher returns from investments usually means taking higher risk, which can lead to even higher losses. This is the complex cycle of returns and risk that investors often find themselves in. They lose money in the stock market. Successful value investors minimize the risk of big losses by keeping a large margin of safety instead of chasing speculative opportunities. This can be achieved by focusing on just a few sectors and businesses that can actually understand. Even though this might not always result in market beating growth, avoiding losses put value investors in a better position to achieve high risk adjusted returns. So, coming to number 7, that is know the reason for selecting investments. Value investing is not a passive investment strategy. Instead, stock selection is a critical feature that distinguishes value investing from other investment styles. A successful value investor has in depth knowledge about his investments and must be able to answer some critical questions about the investment choices, such as what does the company do, who are the competitors, what is the company's competitive advantage, which valuation model is the best for the stock, and why is the stock selling at a discount, and so on. But beyond knowing these details, it is also crucial for a value investor to stay updated on any recent developments that are affecting the company. This can be done by reading and understanding the company's financial statements, participating in quarterly analyst calls, meeting with the firm's management, and interviewing past employees. Additionally, one also needs to get perspective of other stakeholders like competitors, suppliers, and customers to get a clear picture of the company's prospects. Unfortunately, a majority of investors don't do this, and that is one of the key reasons why value investors and its practitioners from a very small part of the investing population succeeds. Coming to number 8, that is to understand the market dynamics before investing. Value investing requires investors to respect the market dynamics and make investment decisions when conditions are favorable. Benjamin Graham described this by using an imaginary character, that is Mr. Market. When Mr. Market is in a very optimistic mood, he quotes a high stock price, but when he is in a less optimistic or pessimistic mood, he is willing to accept a lower price. Graham uses this example to advise readers that while Mr. Market behavior is quite mercurial, it is ultimately up to the investor to decide whether to actually make an investment or hold off. So, value investors make investment decisions only when they deem the market conditions to be favorable. So, the bottom line is, as value investing requires picking investment is calculated fashion, a successful value investor can never follow a herd mentality. It is also necessary for value investors to be patient, not engage in speculation, and have deep knowledge about the investment choices to succeed. It is rare to come across this combination, so very small number of investment actually engage in value investing. Value investing formulas and techniques. The 10 principles form the core of the process for setting valuation targets for individual securities, determining the intrinsic worth, and driving all buy and sell decisions. Both quantitative and qualitative elements help us identify strengths and weaknesses from multiple perspectives. We shall have a quick glance over it. So, the principle number one is low price to earning ratio. Stocks with low price to earning ratio historically have outperformed the overall market and provided investors with less downside risk than other equity investment strategies. Coming to principle number second, low price to cash flow. Strong cash flow gives a company greater financial flexibility. When paired with capable management, it can be the foundation for stronger earnings and higher stock prices. Coming to principle third, that is low price to book value. That is, when a stock price is low in comparison to company's book value, sentiment about the company or the sector may be overly negative. Potential downside risk protection make low price stocks attractive. Principle number 4, that is the value of the company. We seek to appraise the true intrinsic value of each company we evaluate. Our goal is to make careful investments by purchasing stocks when they trade at significant discount to our estimate of their true value. Coming to principle 5, that is financial soundness. We must prefer companies with limited long-term debt. Low debt companies have more flexibility during adverse business conditions because they can direct cash to operations rather than interest expenses. So, coming to principle number 6, that is catalyst for recognition. We must consider consumer, environmental, and other impacts and trends to determine whether a company has a specific catalyst that we believe will cause its stock price to rise. Principle number 7, that is capable management and inside ownership. We meet with the company management teams as a part of assessment of the strength and depth of the leadership. We pair this evaluation with information about significant or increasing stock ownership about the company's management. Inside ownership aligns long-term interest with those of shareholders and can signal management's personal confidence in the business. Coming to principle 8, that is sound business strategy. We seek to understand a company's business strategy by meeting with its management team. These meetings are designed to give us a better insights into the team's conviction, confidence, outlook, and future plans for the organization. Coming to principle 9, that is positive earnings dynamics. Earnings tend to drive stock prices. So we must prefer companies that recently have demonstrated earnings that have upwardly trending estimates. Coming to the last principle of this agenda, that is positive technical analysis. A stock historic and most recent price movements can help determine future changes. We must prefer stocks that are trading with a narrow price range following a previous downtrend. So, now coming to how to profit from value investing and how to make money off value investing. Value investing is an investment strategy in which investors look to buy that are trading below the intrinsic value. Simply put, value investing is an investment strategy in which investors look to buy stocks that are on sale. However, that is oversimplification. Value investors are looking for that are trading below their intrinsic value. This is an important concept to understand. An intrinsic value is what the company is really worth, which can be very different from what the stock price shows. And while that price discovery may take a while, value investors know that over time the market is highly efficient. Good stocks will reach their true value at some point. Now we will explain the value investing and offer insights on how to profit from this strategy. How to identify value stocks. Value stocks share many, but these are some of the characteristics. They are companies that are in the mature phase of its business cycle. They offer steady growth. They have reliable revenues and earnings. They may pay a dividend. So, how does value investing differ from growth investing? Both investing strategies require level of discipline and commitment. However, value investors are looking exclusively at stocks that are trading below their intrinsic value. Overvalued valued stocks are not a consideration. Growth investors, on the other hand, are content to ride the wave if they find a stock that meets their growth objectives. Tesla stock is a good illustration of the difference between growth investing and value investing. In 2020, Tesla stock was driven to the moon as saying goes, but the rally forward was largely being driven by the investors. So here are some strategies that can help you make a better value investor. Don't confuse price with value. Price is what you pay for something and the value is what it's worth. This is important for value investors to remember because frequently there are good reasons that a stock is heavily discounted. The meme stock of trade of 2021 is an illustration of buying on price alone. However, in many cases, an inexpensive stock is inexpensive for a reason. Value investors will dig deep into companies' financials to see if the low stock price is an opportunity or just merely a reflection of the company's intrinsic value. The next strategy is to rely on fundamental analysis. Every investors need to know how to use fundamental analysis to perform due diligence. Successful value investors will look at fundamental analysis metrics like price to earnings or price to book ratios. However, the difference between a value investor and a growth investor is that a value investor will walk away from a stock that is showing itself to be trading or above its intrinsic value. That would not meet a value investor's philosophy to buy stocks that are on sale. The next strategy is to know what you own. In the context of value investing, know what you own means understanding what sector a stock occupies and and how that may affect its price. For example, the price to earnings ratio of a tech stock should be analyzed differently with other tech stocks. What may seem to be an overvalued stock in one sector may be an excellent value in another sector. The next strategy is to put safety first. The most important guiding principle for value investors is not to lose money. One strategy they use to help preserve capital is by looking for stocks that have appropriate margin of safety. This means not just looking for a stock that's selling. One strategy they use to help preserve capital is by looking for stocks that have an appropriate margin of safety. This means not just looking for a stock that's selling below its intrinsic value, but a stock that's trading significantly below its intrinsic value. This gives a stock its maximum upside potential. So, coming to the next strategy and the final one, that is value stocks frequently pay dividends. Many promising value stock candidates tend to be mature companies. When a company has achieved this phase in its life cycle, there is a less of a need to plow money back into the business. At this time, many companies choose to pass along some of its profits to shareholders at the way of a dividend. However, the absence of the dividend does not mean that a stock is not a value stock, but it may have to be clear a higher bar for the value investors to climb aboard. So, Being a value investor also requires patience because once you identify a stock that's trading below its intrinsic value, it can take years for that stock price to rise. Being able to buy and hold stocks is an essential part of value investing. Deep value investing an ultimate guide. Classic value investing, modern value investing, contrarian investing, deep value investing, with so many value investing terms batted around, it's easy to get lost. Investors today have a tsunami of investment styles to choose from, not to mention index investing. This variety has caused a lot of confusion among the ranks of value investors as new investors try to find their financial footing. Many pick up value investing after discovering about the legendary investors and their cult-like following. They dig a little deeper to figure out how exactly they earn the enormous wealth. It's not long before smart value investors begin to probe the depths of deep value and realize that these strategies were responsible for largest percentage returns. But what exactly is deep value investing and should you use deep value to earn your fortune? To really do this topic justice, we need to start by contrasting modern value investing with classic value investing because deep value is firmly embedded in classic value concept. So, indeed, many investment professionals see any mixing of the two terms. The following quote is taken into the account. In our opinion, the two approaches are joint. Growth is always a component in the calculation of value, constituting a variable whose importance can range from negligible to enormous and whose impact can be negative as well as positive. With this quote, the legendary investors forever used growth investing with value investing in the mind. We will later to go on to explain the old style of value investing, but it seeks to identify firms that have significant competitive advantage so that they can maintain profitable growth. Firms with competitive advantage also have high returns on capital, that is, a high return on equity, which make them superior business from capital allocation standpoint. If you are a business owner and want to put your cash to work in the most productive way possible, you pursue capital projects that can sustain high return on capital. Classic value investing, by contrast, doesn't specifically look for great businesses. While it's always nice to buy a great business, the focus of classic Ben Graham value investing is just buying a dollar for more for much less than it's worth. This would include buying firms without moats, also known as commodity businesses, firms suffering from terrible business problems, or even firms in bankruptcy. In fact, while the profitable investors acknowledge the importance of strong competitive advantages, good management, and other intangible advantages, they thought it's best to exclude them from analysis. For one, if the business indeed have a great management, that fact would be reflected in the business results themselves, the firm's financial statements. If intangibles such as brands have any value, then they would have allowed a business to earn above average profits on tangible assets. The idea of looking for business with strong competitive advantages was redundant for profitable investors, since they often based their valuation on companies on standard ratio such as price to book ratio, price to earnings, or price to net current asset value. While there's a bit more to it than this, it, it could be simply to look at the ratios to get a sense of which firms were cheap based on the stated record. The shift was to start looking at great businesses and then to pay up for these companies, expecting the profitable business growth to continue. While some investors was more happy to pay price to earnings of 20 to 30x for a great company. For example, the other investors would never place that much trust in a company's future growth prospects, explaining that the future is something to be guarded against. Instead, they would buy the earnings the company was producing today for much less than they were worth in the market. So, what concept does the legendary investors have regarding the deep value investing? Ben Graham would not disagree that the sum total of all future cash flows discounted at an appropriate rate could be a solid assessment of the fair value. But their preferred definition varied quite a bit. They say that the newer approach to security analysis attempts to value a common stock independently of its market price. If the value found is substantially above or below the current price, repeating again, the newer approach to security analysis attempts to value a common stock independently of its market price. If the value found is substantially above or below the current price, the analysis the analyst concludes that the issue should be bought or disposed of. This independent value has variety of names, the most familiar of which is intrinsic value. So, a general definition of intrinsic value would be that value which is justified by the facts. Example, assets, earnings, dividends, definite prospects. In the usual case, the most important single factor determining value is now held to be indicated average future earning power. Intrinsic value would then be found by first estimating this earning power and then multiplying that estimate by an appropriate capitalization factor. Graham would also later go on to define intrinsic value as the value that a knowledgeable businessman would place on the business. This gave Graham an enormous amount of flexibility in his approach. Some later investors would make good use of this definition, assessing the price of the third parties by paying for the entire business, doing a takeover, then using this data to assess the intrinsic value of the close competitors. So while future prospects were still important, it is preferred to assess value based on the facts or the financial statement figures. Once they decided on which source of value to look at, that is assets, earnings, dividends, they would then apply an appropriate multiple to arrive at a fair value. For example, if they predicted that a company in question could earn $5 per share on average and the market multiplier, that is price to earning ratio, was 50x, he would then multiply the stock at $75. That is $5 average expected earnings multiplying 15 into market price to earning ratio. So we get finally $75. So while he demanded a minimum one-third discount to fair value, the investor would usually buy a stock if it was priced well below $75. The price to earning ratio is only one sort of classic value investing multiple that investors can use when valuing stocks. Investors can also use other basic ratios such as price to book ratio, price to tangible book value, price to net current asset value, price to sales, or price to cash flow. In fact, considering this type of financial ratios to the defining characteristics is the best way of investing. It's rare for a firm to trade well below its liquidation value, but these are exactly the sort of companies that deep value investors look for. Deep value investing is the practice of buying investment for ultra cheap prices relative to conservative valuation frameworks. When it comes to assessing the fair value of a stock, there is a clear hierarchy of value. Some valuation methods are clearly more conservative than others. Deep value investing either demands an incredibly low price relative to fair value or a discount to an ultra conservative assessment of the value. Take a look at some definitions. Value in growth. This is value an investor places on the larger future earnings when there is no clear indication that the firm possesses a strong competitive advantage. It's also what most of the Wall Street looks at, which is partly why most professionals have such a terrible track records. Franchisee value. The value an investor places on the firm's ability to earn much higher than average returns due to possessing some strong competitive advantage. These are the sort of firms that successful investors looks for and are typically assessed using discounted cash flow. Private market value. This is the method written about above. Firms are valued relative to average takeover price in the same industry, and industry prices can be inflated or depressed, however. Earnings power. This is the firm's ability to produce profit now, today. It is often estimated using past earnings and extrapolating forward. This valuation is often written as a price to earning multiples. Coming to the book value, this is the company shareholders' equity and reflects the lower of the firm's historic cost of the assets or the market value of those assets. This is a favorite of academics testing value investing and market inefficiency. Now, coming to a few more definitions, dividend value. The idea here is to look at firm's dividend and then to apply a market yield to arrive at a fair value measure. Dividends can often continue when earnings drop, so this method is more conservative than earnings power value. With all of these sources of value listed here, investors usually make other adjustments. Tangible book value. An offshoot of book value, that is, tangible book value excludes intangible assets and goodwill. Our own high performance ultra strategy uses this as assessment of value. Negative enterprise value. Enterprise value is market cap plus total debt minus cash. If there's more cash than the value of the company's debt and market cap, the enterprise value is negative. Coming to net current asset value, this is an offshoot tangible book value, but investors exclude long term assets from the calculation to arrive at a rough assessment of the firm's liquidation value. Coming to the final definition, that is net working capital, this is a more conservative approach to the net current asset value, and current asset accounts are discounted by varying amounts to arrive at an ultra conservative assessment of a firm liquidation value. Investors used this strategy and bought net current asset value stocks to earn the higher percentage returns of their life. While deep value investing focuses on both marginally conservative and most conservative categories, it concentrates heavily on the most conservative valuation methods. In other words, every valuation methods in the most conservative section can be considered deep value. But for marginally conservative sources of value to be considered deep value, stocks must be purchased at small fractions of their assessed intrinsic values. Comparing two investments, a stock price at a one-third discount to the net current asset value would be considered deep value, but a stock trading at a one-third discount to its earnings power wouldn't. For earnings power company to be considered a deep value investment, it would have to be priced at an ultra cheap multiple to its average expected earnings, that is, perhaps at a 60% discount to fair value. So, if you are new to value investing and you want a comparatively easy approach that produces high returns, deep value investing is your ticket. When you combine deep value investing with mechanical value investing, you can achieve both safety of principal and a great chance at a great average annual return. So, is deep value investing risky? The irony is that while most of these firms are suffering large business problems, deep value stocks are fairly low risk as a group. The firms suffer smaller drops than the flying companies when bad news hits. Many deep value strategies can even ride out of some market downturns, providing a solid gain for your portfolio during a down year for the index. Deep value investing final thoughts. It's pretty obvious that deep value is the obvious choice for small investors today. The returns are excellent, and you don't have to be the legendary investment genius in order to reap the rewards. But keep in mind that buying deep value stocks is not like buying high quality businesses. It requires a significant amount of diversification. It also requires the ability to sort firms with solid value confirms that are just junk. All of this requires some degree of investment skill, even if it's not on the level of the high skill investments. So, now coming to value investment examples. The concept of value investing is very simple to understand but quite difficult in practice. The simplicity of value investing comes from what a value investor is trying to achieve, trying to buying a stock or financial asset for less than its worth. Value investing is highly analytical and logical exercise in determining the real value of the stock against the price that the market is asking for it. What value investing is not? There's a vast majority of investors around the world who are trying to make a quick buck. This is done by speculating the quarterly earnings number in a company's upcoming meeting. The idea for them to make a quick 5 to 10%, and it is very likely that the bet can go through as well. A value investor takes a view that a quarter is too small a horizon for a company to either mend its problems or show significant improvement and growth. Hence, it's important for you to be patient for a couple of years to know that demonstrable improvement in revenue and earnings performance, to see a emergence of a catalyst. This way, you can mildly define value investing as passive investing. So, how to identify value stocks? It is not uncommon to see people suggest that value investing is an art of buying lousy businesses at throwaway prices. The truth is far from it. Value in businesses can come in different forms. Let's examine a couple of techniques in identifying value stock. Number first, identifying hidden value. Value investing finds a lot of warmth with discovering hidden assets in a business which the seller is not evaluating. A quick example. You go to a shop to buy a wallet and you find one for rupees 400. But since the shop was closing down, there was a fire sale and the seller was offering it to you for rupees 100. That's one type of value. But let's say while searching, you come across a rupee 400 wallet which has no discount available on it. But to your surprise, the owner had mistakenly left a rupees 500 note inside the wallet. This means the price of wallet has dropped dramatically from rupees 400 to minus rupee 100. This is deep value for you as you are getting the wallet free of cost and you are earning rupees 100 on the top of it. Now you must say that that's just a good luck. That's true, and that's what hidden value finding is all about. Here are some real world examples. If you would run today's stock screener and found that there are 30 companies in the stock exchange which have more cash in the company than the total value which one can buy 100% of the company. Some of these companies will be known to you. Notice that the cash in the company is higher than the market capitalization. That is, value of all the outstanding shares in the company or market price per share into number of shares. In other words, if we have enough money, we could have brought a private limited company for 3000 crores, gone to bank, written a check for 4000 crores in their name and come out with a profit of 1000 crores. So that's a true return of investment of 61%. But a word of caution here. Value investing and investing in general is not a single thumb rule based selection set. Cash in the balance sheet is one of the hundreds of the various parameters one has to identify the right stock to invest in. However, on a broader basis, we can hope that you can see the importance of looking at hidden assets. Seeing the number second point, that is value investing and growth. Often investors look at growth and value as two different styles of investing. This is a case of stereotyping approach. The investors have learned over the years that the value comes in many forms, including growth. So let us explain this with an example. Suppose a country consists of two islands, and the only connection between them is a narrow bridge. The bridge charges a toll of $100 whenever a vehicle wants to pass through it. The two island cities are flourishing, and the number of cars is expected to grow by 20% for over next 10 years. The toll operator has no expenses, so the entire $100 is the profit per vehicle that crosses. So, now we can clearly see growth in this operation as the number of vehicles are increasing by 20% every year. So if 1000 vehicles pass in the first year, then over 5000 vehicles will be passing through in the 10th year. But a true value investor looks at something more. The bridge is a scarce commodity. That is, it is the only connection between the island cities. This means it controls all of the supply and also has pricing power. So instead of charging $100 for all 10 years, the toll operator can charge an increase of 5% each year and see how the revenue graph will change over these 10 years. Growth is an important part of finding value in the companies. This growth should be qualitative and quantitative in nature as explained in the illustration earlier. A growing company offers a high margin of safety to our value calculations. We shall see more about the margin of safety in coming sections. What is intrinsic value? Value investing is an analytical exercise and not just a mathematical one. It should not be construed as a screening of statistically cheap prices earning multiples. The value investing exercise aims to broadly estimate the intrinsic value of the company or business. Note, as explained earlier, this is done as a mix of tangible and intangible factors. Speaking about quantitative factors, one of the key tenets of value investing is to project the future cash flows of the business and then discounting them to the present value, that is today's prices. So why is this done? We do this because revenue of $1,000 earned today is more valuable than $1,000 earned after 5 years. That's because you can use today's money to good advantage and more so because you want to buy the business rather than the 5 years from now. This method is called discounted cash flow, that is DCF analysis, and is highly used and recommended by profitable investors, perhaps the greatest and the most popular ones. Also remember that intrinsic value is never a precise number. Assumptions and predictions can never lead to precise number. Even the greatest investors can only arrive at a range of value for any business. Say this business is worth of $1.2 to $1.5 billion. The point here is that most companies in the stock market do not trade at its intrinsic value at most times. And this is the entire premise of value investing. Identify discrepancies between the business intrinsic value and the market value. Now, Benjamin Graham's approach to investment was contrary to general public's perception towards investing. Graham advocated the use of numbers and investing rules when everyone else viewed investing in stocks as a speculative activity. In other words, no one understood why stocks went up or down or how to value a company. So the concept of Mr. Market and value investing emerged. Let us introduce the concept of Mr. Market. Now Mr. Market is an imaginary figure who would come every day and yell out of a price for a stock. Like all humans, Mr. Market will have good days and bad days. When he's in a very buoyant and optimistic mood, he will offer you a stock at a very high price, and on other days, Mr. Market will quote a very low price. As an investor, you can pick any price that Mr. Market is offering and you can choose to ignore Mr. Market altogether. Patience is a key virtue for any value investor. This is embedded in the principal tenet of value investing, which says that the purpose of intelligent investing is not to invest with the price as the anchor, but finding the intrinsic value. Unfortunately, many people think exactly the opposite and understand wrong of Mr. Market daily changing prices. Any investor with a portfolio of sound stocks should expect the prices to fluctuate and should neither be concerned by sizable declines or become excited by the sizable advances. He should always remember that market quotations are there for his convenience, either to take advantage or to be ignored. So, now let us introduce the concept of margin of safety. When a value investor calculates the intrinsic value, it is based on the estimations about the future. The future is not certain, hence we need more reliability in our calculations. The margin of safety does that job. More specifically, that investor suggests that stocks at 50% lower than what you have calculated as intrinsic value. The larger the margin of safety, higher is the chance of making profits on your investments. That's because it's possible that some of these companies can be loss making while others be simply your value traps. In fact, investors share some important value investing rules which are as follows. Achieve a portfolio diversification of 10 to 30 stocks. Choose stocks in companies which have a large sales number at least $1 billion. Prefer companies which manage conservatively, such as having current ratio of 2, that is current assets in the company's book are twice the current liabilities, which indicates that a company can pay its short-term liabilities with low trouble. The company must have paid dividends for at least 20 years without having missed a single dividend payment. No single year of decreasing earning over the past 10 years. The earnings must have grown at least 3% annually during those same 10 years. The price earnings ratio should be 15 or lower. The difference between assets and liabilities in the business should be at least 1.5 times of the market capitalization of the company. Seems a little strict, doesn't it? So, now coming to how to master the stock market. There are three possible ways using which an investor can try to beat the stock market. That is, you can be a good stock picker and pick better stocks than the average investor. You can be a good market timer and cleverly get in and get out of the market at low and high points. Use leverage depth, so if market is up 10%, then on lever of 2 to 1, you are up by 20%. Over time, we have seen that being focused on point 1 has led to far better and consistent result as compared to point 2. Of course, it doesn't mean that some people are not good at timing the market. It is just that the investors have more success in learning the ropes at identifying which stocks to buy, at what price, and how long we need to hold it. As far as the leverage goes, taking on debt is great and profitable when things are going well, but it will put you out of the business if things are going incorrect. Consequently, you would avoid using leverage in the form of borrowing or using options. The idea for us to focus on what is a good stock and to continue advocate approach one and all. Remember, you have to do two things. Have a variant perception. You have to be right. That is the hardest part. To be right, let's boil down a four-step process that will ensure you have picked up stock market winners who have the ability to be multi-baggers in future. Number one, that is have a circle of competence. Number second, do an industry evaluation. Number third, evaluate the management. Number 4, value the business. Number 5, a circle of competence. A circle of competence is your expertise about a company or an industry. Having said this, we really don't need a big circle of competence. People have built entire stock market career doing nothing else but investing in specific sectors like biotech or banking. The depth is far more important than the size of your competence. You have to set your boundaries and have to be humble about these boundaries. In other words, don't get mixed up into some emerging tech company or bank in Yemen that you have no idea about just because the price to earning ratio of the stock is super low or if the company is posting 300% annual growth. Stay within what you know. Industry evaluation. The question is that what we are asking here is this a good business? Does it have sustainable competitive advantages? Does it have high returns on capital? What are the growth prospects? Is it balanced? Is it generating a lot of cash flow? While this is a company level analysis, we are also doing an industry level analysis in terms of areas like, are the trends in the industry favorable? Are there any headwinds or tailwinds? What are the industry dynamics? Like a Michael Porter 5 forces analysis. The idea here is to look for some sort of information edge which is possible by interviewing present and past employees, maybe visit some stores, talking to management, listening to earnings calls, and understanding the company. We are trying to establish if this is a good company in a good industry. Coming to the second point, that is management. The third element to evaluate is the competence of management. Here are the three questions that need to be asked. Are they good operators? How good are they with capital allocation? Are they trustworthy and shareholder friendly? History is full of instances where companies have been ruined due to the big term acquisitions where the buyer companies took a lot of debt to acquire something which did not live up to the Excel based assumptions. Overall value was destroyed. Coming to valuation, now we have gone through the three filters or selection criteria. The final step is to identify a value to a company or the company share which we are tracking. This does not mean just buying low multiple but declining companies. This process involves the buying of the stocks like Google, Facebook, Amazon, and you want to be asking yourself if the stock of these wonderful businesses is really cheap to warrant an investment stock by you. Remember, you would want to have a margin of safety in your calculations. Now, what is a value trap? One of the biggest danger to a value investor is that we getting caught up in a stock that looks cheap when you buy it and then just stays cheap. Over time, the business deteriorates and the earnings deteriorates and the multiple stays low. This is a value trap. Taking an example of HT Media, investor used to own shares in HT Media a few years back but liquidated all holdings in this company in 2016. You can see that the stock price has hardly moved from 4 years from 2015 to 2018, and since 2018 the price has only dropped. One share of HT Media is today available at a very low price. As we can see here, the company has not grown its revenues in the last 5 years. In fact, the revenue has degrown for each of the last 3 years. So, what we are trying to say is that why does this company is assumed to be the value trap? It may be due to the management may not be clear. It is clearly the primary reason. Capital allocation is the most important function of the good management. The job of the management is to produce high return on equity for its shareholders. This is not being done by this management. If the management has no use for the cash in the balance sheet, then they should have been dispersed it back to shareholders as special dividend. Traits of value trap stocks may be like they have characteristics like diminishing competitive advantages, no patents on unshakable assets, lack of innovation, high debt, poor management, declining revenue growth, and finally declining profitability. Proper research is required while investing in this type of cheap stocks to understand the reason behind their low valuation. It pains every value investor to have been stuck in a value trap. So now coming to focus investing, we will touch on this topic because many beginner investors overboard by investing in too many stocks. This is important trait of value investing. In the early days of investing, we would invest in dozens of companies which did not serve any purpose and spend more time through the list that meaningfully waiting for the stocks to flourish. Remember, investors like beginners need to have more conviction on the stocks that we own if we are going to beat the market. Always focus on owning anywhere from 10 to 20 stocks with not more than 20% in any one of the stocks. This might be totally different what you might have read. You might have read of instances where profitable investors had much of the 50% of their assets invested in a single stock, or some investors saying that one should adequately be diversified and suggesting you own 40 stocks at a time. Once in a while, you can make a big bet if someone pops up that it is super cheap and super safe and add more units. The point here is that it helps to be focused about investing and not all over the place. Focus investing comes from defining your own circle of competence, that is, do what you know, clear investment rules, be patient and wait for the right price to come, get rid of investment biases, high rejection and low selection funnel. Getting rid of investment biases is a very requisite to become a good investor. So, now coming to growth versus value investing and which one should you use. When it comes to making investments, investors can choose between various options, that is, active versus passive, debt versus equity, mutual funds versus stock, and growth investing versus value investing. Growth and value investment styles are among the most commonly used investment strategies, and there are significant differences between the two. The growth investment strategy focuses on identifying companies that can substantially grow their revenues and profits compared to the competitors. So, growth stocks have the potential to witness a sharp rise in stock prices within a short time. On the other hand, value investing is a slower and a steadiest investment approach. Value investing focuses on identifying and investing in companies whose stock prices are lower than their intrinsic value. This strategy focuses on making investment in undervalued stock that can deliver high returns when the stock prices move closer to their intrinsic value. Here we will take a closer look at the two distinctive strategies based on differences in the objectives, valuation metrics, and performance. Knowing these differences can help investors identify which strategy is better suited to the investment goals. Growth investment strategy identifies strategy which identifies whose earnings per share or earnings before depreciation are growing higher than the industry peers. The critical assumption is that this above age average performance of growth stocks will continue in the future. Companies should showing such outperformance might be new or belong to an emerging sector and become an industry leader in the future. The key risk of investing in growth stocks is the potential volatility in stock performance, especially in the short term. What's more, in many cases, growth stocks might be relatively recent market entrants with short or no historical trends that support the premise of future growth. But various factors can play a vital role in companies' growth. For example, Stock growth may be driven by acquisitions made by the company or external factors that provide tailwind to the sector and promote growth. However, value investing strategy takes a very different approach when selecting investments, and instead of focusing on companies posting, recording, breaking numbers, value investors pick stocks of established companies that belong to mature sectors and have more predictable revenues. Value investing is thus involves hunting for bargains by identifying stocks that are priced at a significant discount compared to the intrinsic value of the stock. So, while value investing focuses on current price of a stock for making the selection, growth strategy focus more on the future direction of the company's business. As mentioned, a value investor needs to consider the intrinsic value when making the stock selection. One of the most commonly used stock valuation techniques value investor use is price to earning ratio. Now, we shall see on the above considerations, investors can choose between three possible options. Option 1, pick either growth or value style and stick with it. Option 2, try and pick the strategy that will outperform at a given time. Option 3, buy a few growth stocks as well as a few value stocks. However, neither of these options is perfect and investors need to consider a few factors when selecting one of these options. That is, for example, if one picks either growth or value investing and sticks to it, the investments will outperform and underperform periodically depending on changing market conditions. Now, if an investor selects option 2, success will depend primarily on the investor's ability to time market current correctly every time, which is nearly impossible. Taking the third option would mean always staying invested in a few underperforming stocks that can impact overall portfolio returns. Due to the limitations of the pure value and pure growth strategies, many investors are now favoring the use of hybrid strategies that incorporate the best feature of the both strategies. One such hybrid strategy that has become popular recently is growth at a reasonable price. The objective of growth at a reasonable price is to provide a stock selection criteria that strikes a balance between growth and valuation strategies. Using this, investors can pick and choose stocks with strong fundamentals that are reasonably priced, and such investments can turn out to be quite lucrative and yield high returns within just a few years. While developing and using a hybrid strategy, it might look simple in theory, but it might be quite difficult to implement in practice. So now coming to the final point, that is drawbacks of value investing. With value investing, there is a requirement of a tough mindset. While this can make investing easier on one level, it can also be a challenging mindset to adopt over the long term. As humans, we are prone to make decisions rationally, and this often leads to a downfall as investors. Adopting an investor mindset means eliminating fluctuations and stabilizing from your decision making process basing your actions on factual data. With value investing, the greatest investment you can make is in yourself and your financial education. You must learn to efficiently analyze a company's fundamental information and to always follow the first rule of investing, which is don't lose money, and the second rule of investing, never forget the first rule. The second drawback is hard work and patience is needed. Value investing is not the easiest stock market strategy to implement, so you must be willing to do your homework to be successful. Learning to evaluate a business requires both time and effort, and waiting to see the results of all the hard work will entail a great deal of patience. Watching your stocks rise in value can sometimes take years, and it's not a very exciting process. This can present a very real challenge those investors who crave the excitement of generating big returns quickly. On most days, in fact, value investors will see very little change in the value of the stock holdings. Finally, intrinsic values can be difficult to estimate is the last drawback. Probably the biggest downside of value investing is the challenge of accurately estimating a company's intrinsic value. There are a number of different methods that investors can use to accomplish this task, but all of them require a certain level of expertise to master, and not every investor has a solid background in finance. In determining how to value a stock, you will be looking at all the information that's available about a given business, including its past and projected revenues, earnings, debt, and cash flows. But even hard data such as these can't always effectively account for such intangible and unpredictable factors as changing management styles and evolving market competition. In the end, it will come down to your own skill in research, analysis, and judgment for deciding whether or not a company's stock is undervalued and subsequently worth buying. So, fully understanding the pros and the cons of value investing before you buy your first stock will put you firmly ahead of the game. Value investing may never end up being the most exciting part of your investment holdings, but they can be proved to be the most lucrative. Thank you.